Experts are forecasting more Fed rate cuts. So why did your mortgage quote barely move? Turns out the Fed is pulling one lever and your mortgage rate's controlled by a completely different machine. You've seen the headline. Fed cuts rates. Naturally, you hope your mortgage quote drops the next morning. Then you call your lender and the rate's actually gone up. So what gives? As of late October 2025, markets expect 2 more quarter point rate cuts before year end. One this month, the end of October, and another in December. Some analysts even think it could stretch into early 2026 if inflation keeps cooling. So the question everyone's asking is, will those cuts actually make your mortgage cheaper? In this video, I'll break down quickly and clearly why mortgage rates don't move in lockstep unison with the Fed, where South Dakota markets are sitting at, as well as what the next couple of months probably mean for buyers, owners, and sellers. And, of course, I'll provide you with a practical playbook you can use to win regardless of where rates end up. And if you're in Sioux Falls or Rapid City, wondering why your quote still says 6 point something while the headlines say Fed cuts, you're exactly who this video is for. Okay then, does the Fed cutting their rate help mortgage rates at all? Short answer, Fed cuts help, but indirectly. So the Fed sets an overnight rate, not mortgage rates. 30-year mortgages mostly track the 10-year Treasury yield, plus a mortgage risk spread that changes with inflation expectations, investor appetite, and demand for mortgage-backed securities, what lenders call MBS. That's why mortgage rates sometimes barely budge, or even sometimes rise, on the day that the Fed actually cuts their rate. With the potential cuts coming up, expect mortgage rates to hold their stance until the bond market fully buys into the disinflation story. The bottom line, mortgage rates dance to a different tune than the Fed funds rate. The bonds and MBS, they set the rhythm. According to Freddie Mac, as of late October 2025, national benchmarks show the 30-year fixed rate on average is at 6.2%. Now, looking at the 15-year average for that is around 5.45%. For comparison, around this time last year, the 30-year fixed rate averaged around 7.2%. So today's mid-sixes already reflect improvement, just not the dramatic drop some were hoping for. It's also important for me to put this reminder out there. So remember, your specific interest rate quote depends on a lot more than just the market. Depends on things like your credit and your credit history, down payment, your loan amount. Those items matter just as much, if not more. Most economists expect 2 more 25 basis point or 0.25% cuts before year end. And again, we're thinking late October and December 27th. Those are the key meetings to watch for. Overall, though, the Fed's messaging has been cautious. Progress on inflation has been good, but they want to avoid cutting too fast and potentially reigniting demand. My translation, policy is easing, but mortgage relief depends far more on bond yields and investor spreads than on the Fed alone. Remember that question from the start? If the Fed's pulling one lever, why isn't your rate reacting? This is where it clicks. The real puppet master here is the bond market, not the Fed itself. So if the Fed's easing but bonds are holding steady, what does that actually mean for your interest rate? Reality of that is to expect incremental improvement, not a massive plunge. If the economic reports continue showing cooling inflation and slower growth, the 10-year Treasury yield can drift lower and mortgage spreads can tighten. That's how rates inch down. But if investors still demand the extra yield because of governmental deficits or due to inflation being so sticky, rates can easily hover in the mid-sixes longer than headlines suggest. So what does all of that mean here at home? Let's zoom in on what's happening across South Dakota right now. Statewide, home values are up about 2% year over year, with a typical value around $315,000. Moving even closer to Sioux Falls in particular, average value is around $330,000. That's up about 1.5% year over year. Meanwhile, the median sales price is around $338,000. That's up more than 7%. And although it may not seem like it to some, this fall is seeing faster market times than last. In Rapid City, median sales are down almost 4%, somewhere around 363,000, with longer days on market. Areas like downtown and Rapid Valley are becoming a little less favorable for sellers since we last checked in. Not that you asked for it, but here's my interpretation of all that. Home prices in Sioux Falls are remaining firm, so any rate cuts likely won't trigger discounts, just more competition for quality listings. Rapid City's market, those signals are a little more mixed. We're seeing longer listings are providing some leverage for buyers, though. They're able to use seller credits, request repairs, or use some of those seller credits to buy down their interest rate. All right, let's make this practical. What does all this mean for people buying or selling homes here in South Dakota? Risky first, starting with first-time buyers whose overall qualifications are highly sensitive to the impact that interest rates have on their monthly payment. Every 1/8% matters, especially so in the metro areas around South Dakota. Now on the sales side, the over-optimistic seller, especially in some of the slower Rapid City pockets. Overpricing leads to longer listing times and the eventual seller concessions. Those who have some potential for some real opportunities are those move-up buyers with strong equity in their current home. Local housing inventory is better than last year, and small drops in sales prices could unlock some solid trade-ups. Now, Rapid City buyers who are targeting the softer suburb markets use price dips for leverage. It's also worth it to try and negotiate for any sort of seller credits or repairs. Now, my refi watchers who locked in the 7s last year, current rates could make sense as long as you can recoup your costs. Choose resilient micro markets. School strong, commute friendly Sioux Falls pockets. Avoid consistently declining areas in Rapid City unless the pricing compensates. Now, if you're a current owner, remember your refi math. Look to pursue a refinance only if your break-even point is less than 3 years, or if it makes sense to look at consolidating some of your higher rate debt. Then mind local levers. Okay, what do I mean by that? Shop insurance yearly. And if property taxes get completely out of hand, check out my video where I discuss appealing assessments. Again, if your value seems completely inflated. Now, if you're selling, price to the decade, not the month. Beyond the physical home, buyers are buying their future monthly payments. Now, in my opinion, concessions will always beat cuts. Offer seller credits or buy downs before considering slashing your listing price, sometimes again. Also something to consider in the slower Rapid City submarkets, get a pre-inspection. Clean reports mean faster contracts. Watch out for the Fed's tone at the October and December meetings. Remember, dovish is supportive, but markets must believe the inflation story for rates to drop even further. Okay, recaps to remember here. Fed cuts help, but indirectly. Mortgage rates move when the 10-year and the MBS spreads move. South Dakota is still steady Eddie. Sioux Falls remains firm, but Rapid City seems to be selectively softer. As far as rates go, expect mid-6s through year-end unless Treasuries decisively break lower. Don't try to time the Fed. Optimize what you can control. Shop, lock, and negotiate wisely. So next time you see Fed cuts rates flash across the news, remember that headline is only half of the story. The rest of the story lives in the bond market and in the strategy you choose right here at home. Hey, if you'd like a quick South Dakota specific rate game plan, including a break-even check and micro market shortlist, drop PLAN, P-L-A-N, in the comments, and I'll send you the worksheet.